a soft landing is not our baseline. Those are Powell's word on last Wednesday FOMC meeting on the 20th this week. I'm Romain Carter, glad to have you back this week. Let's directly jump on our datas. On the DXY, like we've seen past week, we still are on an uptrend. We are 0.2% increase this week, where we started this Monday at around 105.3, let's say, to end this Saturday at 105.6 approximately. The 2-year on the 2-year bond, we had a 2% increase this week. So the FOMC, you can see, greatly impacted. Sorry, the chart on the US 2 years. So the same on the 10 years, as we can see, we have 3.4%, so larger increase on the 10-year, with also a major move on Wednesday after Powell's speak at 8:30, but I'm gonna talk later about that. And on the 30-year, we had a 3.3% increase. I'm gonna talk about Powell later. Let's first jump on our S&P chart. We had a big red candle this week, so let's look at it. We are this week we faced a downtrend of exactly, as we can see here, 2.8%. So we went from, if we remember our last report, we were about last closing 44.50 points, and we ended this week at 43.20 points. So big red candle. Let's look on the daily level. That's something I took out of CTO Larson. We can see, if we remember, we had a head and shoulder pattern. You remember I talked about it along. I made also drawings showing it, where I deleted it at the moment because we completed the pattern where this was our neck and we had a potential increase up here. So the banks did take the trade, and while everyone was forecasting a recession, they profited from this, and it ended here. So that was this head and shoulder pattern, and now we are seeing another head and shoulder, as you can see just right here, showing with the shoulder, the head, and another shoulder. So we have the neck, which is here, and we are actually at the moment on the neck, looking at our imbalance here on a weekly level. That's an imbalance. Let's if you remember, we talked about it last week. So we have a big imbalance at that level, which is also a liquidity point from the retail's zone here that would like to buy. So we could have, of course, a test of that zone. We'll carefully have a look at it. So talking about the data, let me clear this up a little so we have less information to understand better. Let's just see the US dollar. So if we remember, that week was mainly the FOMC meeting. We stayed at the same current rate, 5.5. The unemployment claims a bit lower, so not good still for the inflation numbers, and the manufacturing number, the purchasing managers index was a bit higher than the forecast, but nothing important. About next week, we'll have consumer confidence numbers on Tuesday, with more importantly the quarterly numbers on Thursday. On Thursday, we'll have final GDP quarter-to-quarter numbers. Last June, we were at 2%, with a forecast at 1.4%. So about 50% higher than the forecast. Let's see next Thursday if we are at 2.3 or if we are at 3.5, something like that. We'll also have a look at Powell speak. He will speak next week due to, as you can see here, an event in Washington. So we'll also take a look at this final data on Friday, the PCE, of course, which is really important, and Powell mentioned it in his last speech on Wednesday. We'll talk about it later. Again, just a quick look at the probability of the rates. So now we are for next FOMC on November at around 74% of a no change, if I can say, as we can see here. Last week we were at kind of the same level. What has changed a little is basically that Powell, like we will see in the next article, mentioned that a soft landing is not like for them something that will happen for sure. So they want to stay prudent, if we can say. So the main point is that the ease has moved a little. As you can see, last week we were at 36% of the ease in June, while at the moment I mean, when I'm saying ease, it's not like all the numbers, because of course, if you take all this, we are at 42% here. But looking at like just one cut, for example, we were 1 week ago higher than that. So we were at 36%. And now we are back at 1 month level, where basically we have less chance of a cut in the first semester of 2024. That's what Powell said when he wanted to mention that we must move carefully, because looking at the data numbers, he is also looking at other information, and he wants to be careful because he is, of course, seeing the market reacting to the inflation number. But he mentioned that a hike could be possible in the next 2 meetings, but like we've just seen, the market don't believe him, kind of, in a sense. So that was the document from this week FOMC. As you can see, almost all juries were at this level, between the current rate 5.5 and 5.75. So if we compare this with the previous projections we had on June, I do it later, but just have a look at that first. Looking at on the longer run, for example, in 2025, the range was kind of around a bit lower, 4%. So last June we were for 2025 lower than that. We were closer to 3.5, and basically what it means is that the Fed is now projecting to ease the rates more slowly than they basically projected in June. So that would be the point of last FOMC. What I wanted to highlight, it's kind of a birthday. The US national debt reached 33 trillions. So congratulations. That's a big number, 33 trillions. I just wanted to have a look to Joe Brown from Erezi Financial YouTube channel. Just have a look to his last video like I think it's quite funny. He made a calculation where basically you can see that every 10 years the debt of the US is doubling. So in 1993 we were 4 trillions, 25 8 trillions, 2005 sorry 8 trillions, 2013 16 trillions. Nowadays we are at 33 trillions. So on his expectations, we would reach on 2073, sorry, $1 quadrillion debt. So I thought that was quite funny to look at that. What do you think about it? Is that possible? Finally, I wanted to answer to take back also something that CTO Larsen showed in his last video, is basically that at the moment, so I'm on the monthly level, you can see the S&P data. We are expecting, I mean, some forces in the influencers in the financial industry are saying that when the Fed will cut the rates, that's the moment we're gonna rally on the S&P and all the risk on assets are gonna skyrocket. I mean, that's not what history says to us. Let's just jump back in last crisis. So if we remember correctly, on the two last crises, it's actually when the rate is falling that the market crash. So in 2000, the rate were, you can see the rate on the left, we are 6.7% when just before 1 month, 2 months actually, well, 3 months, 1 month, 2 months, 3 months, yeah, we picked 3 months on the 2-year bond, because yes, you can see it's the 2-year yield. So on the 2-year bond, we picked 4 months before the S&P reaches its all-time high, and the yields has already started falling back. So that could be an indication for us, since the rate is actually at all-time highs at the moment, will mean it's not like in the next month, in the next 2 months, but maybe in the next 4 months, 5 months, 6 months. Let's see in 2009, 2008, how it happened. So the crack was mainly on, of course, if we remember, September, October 28, 2008, and the bond market like peaked way before in June 2006. So now we're talking about 2-year difference. If we take the kind of equal high on June 2007, we can say 1 year. So looking at that, we could just make a correlation. I mean, it's not a causal consequence. I mean, it's not a proof, but looking at that, since the market is at the top at the moment, will we see a crash in 4 months, 5 months, or maybe 1 year? So that's our averages. Let's say 8 months. So that would lead us to first semester 2024. We're gonna have a look at that. For me, it will be the end of the video for now. It's been a pleasure sharing with you this week. We're gonna have a little chat again next Saturday, and I wish you an amazing week to everyone. Bye-bye.